right now. Ashi, hi, afternoon. Let's address the positives right now. The fact that crude has seen quite a bit of cool off. The fact that Indian markets also have had a very resilient reactions to what's been happening at the LOC. And the earnings so far, Ashi, other than very, predictable candidates, we've not seen very huge disappointments in the earnings so far. Where is it that you're finding fresh investment opportunities right now? Or would you say just wait it out because you don't know how the India-Pak situation is going to pan out and maybe the market may get a little bit more choppy from here?
Yeah, hi. So firstly, thanks for having me on the show. If you're looking at the market outlook, I think there is a kind of decent combination of both positives and negatives. You did mention kind of oil prices coming down, interest rates have cut twice, RBI is infusing liquidity into the system, FI flows have kind of turned positive. All of these are kind of relative positives, and also valuations have come off a bit post the recent market corrections. So while there are positives in the market, I think we are still choosing to be a little conservative. We are watching quite closely the entire India-Pakistan LOC situation to really see how that develops. We really hope it does not escalate any further than what we're currently seeing. But that is clearly a near-term uncertainty that can impact the markets. The other important element is just the whole Trump trade aspect is on pause for now, but we really do need to see and understand how things are going to evolve. These are two key uncertainties. You did mention corporate earnings. I think it's fair to say that while corporate earnings, we've not seen any major disappointments, but by and large, earnings have been muted. You aren't really seeing clear signs of growth anywhere. So while the interest rate trajectory has clearly improved, I think before we get a lot more positive, we are going to wait for greater signs of growth to come back, and also some kind of clarity around just how the India-Pakistan situation is going to emerge, as well as what's happening in terms of Trump tariffs.
Ashi, so you do manage a fund which I remember invests in digital companies. After the recent run-up, what's your view on stocks like Paytm and Zomato?
So this is a space, we really see this as one of the most attractive investment opportunities of the decade. I think more than kind of the recent run-up and what valuations are right now, if you just step back and understand what's happening at a larger macro level, new age digital tech businesses have the ability to kind of create solutions for consumers that are much more efficient ways of transacting than traditional ways. It is much easier to order food on Zomato, Swiggy as compared to the traditional way of calling the restaurant and having a delivery person from the restaurant deliver food. The same can be held true for kind of payments via Paytm or PhonePe, booking a cab via Ola, Uber. You're seeing a massive value migration away from traditional businesses towards these new age platforms. And this, according to us, is something where it's still in relatively early stages of. We see this kind of supernormal growth, the 20-25% kind of very consistent high growth rates of these kind of platform businesses sustaining well into the coming decade. These businesses have already turned into very large businesses. And if you continue to compound at this kind of a base at these very high rates, these are going to be some of the largest companies in India. The growth is something which I think a lot of people do understand, but what a lot of people do tend to underestimate is just how significantly profitability of these businesses can kind of improve as these businesses mature. There are very large parts of the cost structure that are specifically linked to this current hyper growth phase. As you move into some level of maturity, the kind of levers that these companies have to both increase monetization, reduce costs, and overall improve margins and cash flows leads to kind of, if you look at kind of our profitability projections 5-7 years down the line, they're very, very healthy in terms of levels of margins, level of cash flows, etc. This combination of supernormal growth and a shift towards high levels of profitability are a very strong combination of kind of value creation. And therefore, we believe this decade is really kind of, this is the decade for kind of digital platforms to kind of generate value and create wealth for investors. Now, within that context, while they were available quite cheap a year and a half back when we launched the fund, and valuations have kind of gone back towards kind of normalcy, even a bit expensive. But given the kind of overall growth outlook that these companies have, we continue to see this as a very, very attractive longer-term investment opportunity.
Okay. You today, and good old comparison between Swiggy and Zomato will always happen. Now you got to bear in mind that Zomato numbers were not extraordinary. Slowdown happened in the food business, and Blinkit is going to be in this investment process, which means that for next 2 quarters we may not get anything large in terms of a big surprise coming from there. Ashi, is it time to flip Zomato to Swiggy now? It's available at a 50% discount.
So we're not very sure. As in, we find both of these as very attractive kind of plays. Food delivery obviously is a business which has matured and is very attractive from a longer perspective. Quick commerce is something where it's really extremely scalable and a very, very large business opportunity. Now, when it comes to kind of quick commerce, investors are going to have to contend with losses increasing in the near term. Our own assessment is that the next 2 or 3 quarters, losses are going to increase. You've already seen kind of for Blinkit, it go from about 100 to about 80 crores. We believe losses could increase further as these companies continue to kind of roll out aggressively and really try to capture as much of market share as rapidly as they can. But this is really the kind of digital playbook when there are these large opportunities that can be serviced by digital platforms. It is a kind of very often a winners take all kind of market. These markets tend to evolve into strong kind of duopoly or 3 or 4 key players that control the entire market. It's a multi-billion-dollar opportunity. You're looking at kind of a shift of overall grocery and various other consumer segment spends towards quick commerce. So it's a space that we believe these companies are going to continue to invest in, but has the potential to create a lot of value going forward. When it comes to kind of Zomato versus Swiggy, that 50% plus discount that a Swiggy kind of trades at to a Zomato is probably kind of well deserved. If you look at the relative kind of growth momentum, the different levels of profitability, right? And if you just step back a bit, Swiggy was the first to actually start food delivery. Zomato's moved ahead of them. Swiggy started Instamart before kind of Zomato went out and acquired Blinkit. Blinkit is considerably larger than Swiggy's Instamart as of today. Profitability on both the food and the kind of quick commerce business for Zomato is superior to that of Swiggy. If you actually take into account the differential in terms of scale, the differential in terms of profitability levels, and also overall execution, the 50, 55, 60% kind of a valuation discount, according to us, is broadly appropriate. At kind of current levels, we hold both Zomato and Swiggy in our portfolio. We continue to see both of them as very, very attractive longer-term plays, but it's not between the two. We probably still have a slight preference over Zomato. But if Swiggy were to be able to get its act together and to narrow the kind of execution gap to a Zomato, this valuation discount could clearly have potential to reduce.